Under surveillance this morning, the Fed remaining patient.
We're headed back down toward normal. The question is, of course, are we normalizing or are we weakening? Those are two very different things.
Underneath the hood of the labor market report, there's a little more room for confidence. Confidence that we're slowing but not falling off a cliff.
You know that I believe that we are restrictive. The longer we were restrictive, we're going to have to start thinking about the employment side of the mandate.
So here's the latest. Fed officials refusing to overreact to last week's payrolls data. Former New York Fed President Bill Dudley suggesting that patience might be misplaced. Writing this, the Fed's wild ride has only just begun. A deteriorating labor market tends to be self-reinforcing. The longer the Fed waits, the greater the potential for damage. An immediate rate cut is in order, but that's very unlikely. Prepare for more volatility in stock and bond markets. Bill joins us now for more. Bill, let's start with the labour market, then we can get to the Fed's lack of response to it. What suggests to you that this is self-reinforcing? This is the beginning of something much worse?
Well, a couple things. Number one, we've seen a rise in unemployment claims. We've seen a drop in the hires rate. We've seen a drop in the quits rate. It looks to me like the labor market is cooling off quite significantly. We've also triggered the so-called SOM rule, where if the unemployment rate rises by more than 0.5% over a 12-month period, every time that's happened, we've ended up in recession. So there's a lot of risk out there to the downside in terms of the labor market. On the other side of the mandate, the inflation news has been very, very good recently. So it seems to me that the Fed needs to hold both sides of the mandate with equal weight right now, and that implies that monetary policy should be neutral, not restrictive. And we're a long way from neutral. I mean, people don't know exactly what a neutral monetary policy is precisely, but nobody thinks that 5.25% to 5.5% federal funds rate is consistent with neutral. Probably somewhere in the 3 to 4% range is where the Fed should be.
Bill, you've had an enormous influence on how people are thinking on Wall Street about what's ahead. So I want to ask you, if you think an immediate rate cut is not on the table, that they won't move into meeting, what would you recommend they should do in the next few weeks?
I think what they should do is change the messaging a little bit and make it very clear that they're now focused more on the labor side of the mandate, get the market attuned to the notion that if we get weak data over the next 6 weeks, that 50 basis points is highly likely at the September meeting. You can put 50 basis points firmly on the table if the data flow continue in the same direction.
And do you think they'd be willing to do that? This has been a very backward-looking Fed, and now they need to regain control of the narrative. Do you think that that by itself, at Jackson Hole, for example, would be enough to regain control of the narrative?
Well, it'll help a lot, because if people feel that the Fed's got it, financial conditions will become more accommodative, the stock market will recover, and they'll provide support. The problem here is when the labor market starts to deteriorate, confidence starts to decline. We saw that over the last couple of days. The big change in market sentiment, and when market sentiment deteriorates, that can be self-reinforcing. People start to pull back on hiring. People pull back on spending. Next thing you know, the unemployment rate hasn't gone up 0.5%; it's gone up a full percentage point or 2%. Percentage point, you're in a recession. Now, the good news here is that if we have economic weakness, the Fed has plenty of firepower. They're a long way from 0% short-term rates, so the Fed can respond pretty aggressively if needed. And I think my view is that the risk that they're going to need to respond aggressively has increased significantly in recent weeks.
Bill, I just want to put a fine point on that, because you did write about 2 weeks ago, before the Fed decision, before we got the jobs data, that not going in July would increase the risk of a recession. And all of that happened. So just how acute is the risk at this moment?
Well, I think that what's happened is there's quite a bit of stress in a couple areas of the economy. Number one, low-income households are really feeling it, both because they're tapped out the savings that was generated by the fiscal transfers during the pandemic, and two, they're the ones who pay the higher short-term interest rates in terms of credit card debt and auto loan debt. And number two, we're seeing softness in the housing sector, especially in multifamily construction. So you're seeing areas of weakness that are leading to softer labor market, and that's the softer labor market, though, is the key thing. If it frightens consumers, then you have weakness in consumption, and the thing becomes self-reinforcing.
I think the confusing thing for a lot of people, Bill, is for every weak point, there seems to be a strong point. For every issue at Airbnb, there is a Disney that can raise prices. There is an Uber that people are willing to buy. How do you distinguish between a lower-end consumer that's dropping off a cliff and one that has just gotten more picky with where it spends its money?
Well, it is difficult to sort out, and high-income consumers are doing pretty well. I mean, they've locked in low mortgage rates. They have been the beneficiaries of a very strong stock market. Even after the recent decline, the stock market is still up quite, over 10% this year. So the high-end consumer is feeling pretty good about things, but the low end is not. The other thing, of course, is also what's happening on the investment side. The Biden administration had a number of initiatives that boosted investment spending: infrastructure, CHIPS Act, climate. And the question is, what's the impetus from investment from those programs? Has that peaked or not? And if that has peaked, that's another source of potential restraint in coming months.
Bill, it was great to catch up with you, sir. As always, appreciate the comments this morning. Bill Dudley there, the former New York Fed president. Mohamed, just want to get some final thoughts from you. How offside do you think we are on rates when we've spent the last 2 years debating whether we're sufficiently restrictive?
Well, if you just listen to what Bill said, and I listened very carefully to what he said about the labor market, if he's right, we're quite offside. We are way too restrictive.
Like 100 basis points offside?
Yeah, I think the more interesting debate is where's the destination? And I think there's major differences of views here as to what is ultimately the destination. Is it in the 4s or is it below 3?
Well, the market at the moment is certainly focused on the path. You're focused on this. I've just seen the piece that's just dropped. Mohamed's just published in Bloomberg Opinion. How do you do that at the same time as this? Waiting in vain for a Volcker moment. You say the system needs a Volcker moment. What is that Volcker moment?
Well, every time central banks blink, the Bank of Japan blinked this morning, the markets take it further. So it makes the next episode even more difficult. I think a Volcker moment is having the courage, as Paul Volcker had in the 1980s, to say, I'm going to break a certain mindset once and for all. And he broke the inflationary mindset once and for all. But no one right now wants to be the source of that Volcker moment.
Do we need to see something a lot worse, something like Monday, but even more to shake the Fed from that, to get them to do what you're talking about?
Yeah, I think I do, but you also need someone who is confident enough to be able to say, I'll see it through. And that's what we haven't had so far.
So you don't sound like you think that they will change to get where they should be.
No, I don't. I think we're going to continue playing this repeated game until something bad happens. But this repeated game can be played for a while.
Does he need to communicate the destination at Jackson Hole?
He absolutely needs to.
How does he do that? What does that look like? What does it sound like?
He'll say, we've looked at this. This is what our instincts are right now for where we're going. We're going to be going down that path, but we will course correct as we get more information. But you need desperately to anchor this market, John.
Mohamed, appreciate it. Just fantastic. You've nailed the turn in this economy.